Welcome to Investors Guide. You're watching ET Now. This is a show for retail investors. We help you find the right investment products in the market. We help you put them together and create a great portfolio that will make you rich in the long term. This week, we're focusing the show on a very important question. What's going on with gold? Why is the price falling? Is it going to fall any further? Should you be out shopping for gold right now, or should you be cautious? We're going to answer all of those questions later on the show. Remember, there's an email ID at the bottom of your screen. Send in any question you have about your money, about your real estate, your taxes, or your gold. Over the next half hour, we'll start by helping you out. If you're only 10 years away from retirement, we'll organize your finances. In our product review this week, we take a look at the UTI Dividend Yield Fund and find out if gold is going to fall any further and should you be out shopping right now. All right, it's time for me to bring in Virendra Kumar, the CEO of Value Research and our in-house mutual fund expert who joins us every week. Virendra, thank you so much for joining us on Investors Guide. Let's get straight to our portfolio versus portfolio question. Well, Virendra, Captain N.V. Vittal is listening in from Bangalore. He works in the shipping industry and that status makes him an NRI. He's 49 years old and he tells us he's about 10 years away from retirement. He has a term cover of 30 lakh rupees, which I think is too low. You have to try and increase that if you can. He also has a health cover of 11 lakh rupees. That seems about adequate. Now, he wants to invest an additional lump sum of 10 to 15 lakh rupees in debt funds. And he has a fair amount of money going into his mutual fund investments right now. Virendra, you always advise us to re-look at our portfolios when we're about 5 years away from retirement. Is this the right time for him to be re-looking at his portfolio?
I would say that, he's thinking of making 15 lakh rupees into debt funds, considering MIP as well, making these investments into equity funds, a third of that going into gold funds. I think he needs to take a holistic view, which is plan his cash flows and accordingly plan his allocation. If all this money is going to be a long-term investment only and he needs only a part of it in his retirement, then he should well consider a stable growth portfolio, 70% into equity, 30% into fixed income, all into one portfolio, a tax-efficient way of approaching this. If he needs the fixed, if he has planned for it, he needs a part of his money or significant part of his money or the 15 lakhs which he plans to invest in fixed income, definitely 3 years from now, then he should think in terms of, bifurcating it, treating it differently, and consider a debt bond fund there.
All right, last question, Virendra. He has the Quantum Gold Fund. He's been putting 10,000 rupees into that fund every month. Obviously, pulling out money from gold is not very wise right now. What would you recommend he does with that investment?
Gold should be held by individuals in their portfolio. If they need to really, convert that accumulation into a gold fund into real gold at a future date. So you are eliminating the possibility of, an off-date chance that gold will be way too expensive and you may not be able to afford it when you need it for consumption or your daughter's wedding or some such goal. But I think, all your incremental savings, 25% going into gold, if it is just an investment, then it should not be 25% of your incremental savings in the first place.
Also, Virendra, you did mention the fact that if he wants to combine our stable growth portfolio with a debt fund, he can use one bond fund. Can you give him the name of a fund he can use?
Given his time frame, I would suggest, he can consider dynamic bond fund or a short-term bond fund. Dynamic bond fund can be a little more volatile, but 3-year time frame, I'm very hopeful that it should be able to beat. It will be tax efficient. At the same time, it will give him marginally, or maybe substantially superior return than a term deposit. And choosing a couple of funds, I would say SBI Dynamic Bond Fund or Birla Sun Life Dynamic Bond Fund or UTI Bond Fund.
All right. We have another question from Gautam who wants to invest 5,000 rupees a month for his child with a 25-year time horizon. He wants to know if he should invest that 5,000 rupees in one fund or across various funds. And he also wants to know what the minimum age is going to be to begin investing for his child. So obviously, for someone with a 25-year horizon, it's not something he should just pick up now and forget about it, but what would you recommend he does with this 5,000 rupees?
It's always good to diversify beyond one fund. And at the same time, diversify to a point that, it does not become very complicated. So I think, 2 funds should be good enough to begin with. More importantly, he should be reviewing his investments at least annually. The second part of the question, which is, can he invest in his child's name? Yes, you can. There is no minimum age. Yes, but till the child attains majority, he will have to operate and his KYC will be valid for his investment.
But Virendra, could you give him the names of a couple of funds he can use for such a long-term horizon?
I would say he should take 2 funds from our aggressive growth portfolio and check for those names still being there at least annually.
The choice of funds is on your screen right now. Remember, you can reach us again if you have any more questions. Virendra stays with us on the other side of this break. We'll review the UTI dividend yield fund. We'll find out how it managed to tide the volatility of the last 1 year. Welcome back. You're watching Investors Guide in 80 now. Thank you for staying with us. It's time for our product review, and this week we're looking at the UTI Dividend Yield Fund. So this has been an impressive fund for a very long time. It has 5 stars in value research. I am not impressed, though, with what it's done over the last 1 year. So we're going to take a look at this fund and find out if those of us who invest in this fund should be worried. Avan is here to first give us an introduction. Avan.
Thanks for that, Faye. Now, like the name suggests, a dividend yield fund is a fund that invests a large portion of its portfolio in stocks that have a good track record for rewarding investors with dividends. This strategy rewards investors who are looking for steady returns without taking on very high risks. The UTI dividend yield's long-term track record is very impressive. In 2007, it gave its investors a return of 71%, ahead of the Sensex and its category average that gave 47% and 61% respectively. During the downturn in 2008, it lost less than the broader markets, and in 2010, the fund was able to stay ahead of its category. Unfortunately, over the last year, the fund's performance has slipped. In 2012, when the Sensex returned 25% and the category average was 30%, this fund only managed a return of 20%, dropping from a rank 8 to rank 70 in its category. So what's behind the weak performance? And should you as an investor start to worry? We'll find out. With that, it's back to you, Faye.
Thanks, Avan. Virendra, the UTI Dividend Yield Fund is still a 5-star fund on value research. But if we look at its short-term performance over the last 1 year, it's fallen more than its category average. It doesn't seem as impressive. What's going on with this fund?
No, I think last 2 years this fund has struggled, and its long-term performance is still keeping its. But it has managed its the declines much better. It doesn't fall as freely, and the rating based on 5-year performance. It's the earlier 3 years is actually helping it guard its rating. Also, lower volatility, which translates into lower risk grade for this fund, is helping it. But yes, last 2 years it has not been as impressive. But I still feel that it's a very well diversified fund. It has been true to its label, which is having a portfolio with reasonable dividend yield. High yielding dividend yield stock portfolio, and if market is turbulent, this fund will hold ground better. And this kind of cyclicality is visible in all good funds as well. So I would say that this fund sticks to its approach, and it's not a fund worth writing off. It has lost a bit of its momentum in the last 2 years.
For those of us who have invested in the UTI dividend yield, what would you recommend we do now? Should we continue our SIPs and just watch it for a little while longer?
No, I would say that, if it is part of a diversified portfolio, if you have 2-3 equity fund and this is one of it, or a third of your portfolio, or a fourth of your incremental investment SIP allocation, then it's fine. But if it's the only fund, I think it's time to worry. It should not be the only fund which you should have.
All right, Virendra, finally, your rating of the UTI dividend yield, where would you place it?
I would slot it as a 4-star fund, lower than where our risk-adjusted rating scale places it.
All right, UTI dividend yield, they're being downgraded on Investors Guide from 5 funds to now 4 funds. Virendra, they're saying if it is the only fund in your portfolio, then you should have cause for concern. Write to us if you have any more questions about that fund review. Let's move on now to our hold or sell segment. As part of our ongoing effort to get more and more women to become investors in mutual funds, we're taking one question from a woman every week. And this week, it's Mitali Menezes. She's 74 years old. She's been investing to create a retirement corpus for when she's 50. She wants to know if her portfolio is on track, Virendra. Right on top, and these are regulars on most portfolios, DSP BlackRock Top 100 and HDFC Top 200. Continue both of these investments?
Yes, continue both these investments. DSP Top 100 remains a large cap fund. It is among the better ones, so one should hold it. HDFC Top 200 going through a lean time, and given its long history and past 2 years its struggle, I would say continue with this plan for now.
The next on our list is ICICI Prudential Dynamics. She's investing 3,000 rupees every month. This is a strong fund. You gave it 5 stars last week. Continue that investment?
Yes, this fund has been very impressive, and its value orientation with its equity allocation and the kind of flexibility it enjoys. It can change its color, and it has done well over a reasonably long period now. Carry on with this fund as well.
Reliance Equity Opportunities is the next on her list, Virendra. 3,000 rupees every month. Continue the SIP?
Yes, this fund has been among the most impressive funds from Reliance AMC. Should carry on as well. So this could be a high performance component of the portfolio.
She also has IDFC Premier Equity. Compared to the rest of the funds that she has, does she need this extra fund?
No, I think this is also a very impressive fund. These funds, she has chosen are very well performing funds, credible history. None of them is non-performing, and they are not. It's not a duplication. What I find in these 4 or 5 funds so far is that it is not an unnecessary addition to the portfolio. It's not the same underlying portfolio which is held.
Next on her list is the UTI MNC fund. This is not a fund we come across on a regular basis. She's investing 5,000 rupees in this fund, which is more than what she's putting in the rest of her fund. She should continue that investment?
Yeah, this is an offbeat fund, and this has been a very impressive fund so far in the past 5-6 years. Also because it's a very old fund, and this fund was launched at a time when MNCs had their charm. Compared to Indian companies, MNCs were preferred, or they used to be perceived differently or more positively by investors. I think times have changed, but this fund has its focus in FMCG and healthcare, which has done very well in the past 4 or 5 years. If one looks at a conservative fund, this fund also justifies its role here, plainly based on its performance.
Last on her list is the SBI Emerging Businesses. We also know that this one has done well. Continue the investment as well?
Yes, this is also a very well-performing fund. It's extremely volatile fund. So if one is fine with the volatility, then one should continue investing in this one as well.
All right, Mitali, 2 thumbs up from Virendra Kumar on your mutual fund portfolio. You seem to be on track. He said don't make any changes. Just continue your investments. All right, Virendra, thank you so much for spending time with us this week and answering our questions. Remember, if you have a question for Virendra, email ID is at the bottom of your screen. You can also reach us on our Facebook page. Coming up after the break, the big segment I promised you, gold. We'll talk about what's going on with gold and if you should be buying any right now. Don't go anywhere. Thanks for staying with us. You're watching Investors Guide on ET Now. I've asked Naveen Mathur to join in on the show this week because of all of the questions that you sent in about gold during the week. I know it's It's unusual behavior for the price of gold to fall this much in just 2 weeks, which is why it's a good thing we have Naveen. Naveen, thank you so much for joining us. We'll start off obviously by asking you to explain to us what's going on with the price of gold.
See, there are a number of reasons for the gold or the silver prices to come down in the last couple of days, particularly 2 weeks or so. The trigger happened because of the Bank of Cyprus being talked about to sell the gold reserves to make good their losses on the bank losses. At the same time, there was some negative news also coming in from the various international institutions, the financial institutions like Goldman Sachs, Citibank, Credit Suisse, UBS, and everybody also talked about that they are looking forward for downgrading or say looking forward to making gold as a kind of a price trend on the bearish note. So their estimations that the gold would come down also triggered to a large extent the selling pressure which we saw the gold in the last week. For Indian markets, we saw the rupee appreciating in the last couple of days. That also put a pressure in Indian rupee terms to come on the downside. Particularly the Indian prices and the international prices are highly correlated, and therefore any downfall, significant downfall in international markets would lead to the prices here in India also to go down.
Well, Naveen, I think what most of our viewers really want to know at this point is, do you expect gold to fall any further? And for those of us who are long-term investors, should we be going out right now and buying gold to add to our portfolios?
Today, where we stand, the markets are in gold at around 26,100, 26,200 levels. Frankly, if you ask me, the trend is bearish for immediate to a medium term. Maybe a little bit range bound, not to a slight kind of an upside, but then a little bit on the range bound. We will see the prices hovering around 26,000 and may consolidate around these levels in the intermediate and the medium term. Physical demand may come in. We are already hearing news in India that jewelers does not have a space to sell gold. People have flocked to the jewelers shop to buy gold at these low levels. So I think the physical demand picking up and remaining on an up, kind of a good demand continuing. I think in a long-term basis, you may see the gold prices picking up the momentum on the upside. And at the same time, the long-term perspective, and long-term to my understanding would be around 3 years to 4 years from here. We may see some kind of the pullback on the upside, which may lead the gold prices in Indian markets to approximately 30,000, 31,000 levels. But don't expect immediate returns out of gold as of now.
Alright, so this might be a good time to buy gold, but Naveen, they're telling you what you should be expecting in terms of returns. Naveen, we have a couple of questions for you. Devarajan has written in from Tirchi in Tamil Nadu. He tells us he started SIPs in the HDFC Gold ETF. Right now, with gold prices coming down, he's read a couple of magazines that are of the view that ETFs are a flawed product, and it's advisable to discontinue his ETF investment. Now, for someone like that who has an ETF in a gold fund, would you recommend he discontinues that ETF, or should he just continue investing at this point?
See, the best thing out of the SIPs means let it be gold ETFs or mutual funds in the equity markets where you keep doing the SIPs. The best part out of this is that it values your total holdings. It averages out to the value of your total holdings. So when the markets are on the downside, you buy the units at a lesser price, and when the market moves upside, you get the gains out of what SIP amount you have put in. So I think there is no point getting out of the gold. Gold has a value attached to it. It's a very, very strong value which is attached to the gold. It also acts as a portfolio diversifier. Now, I'll continue doing it. I don't see much of the reasons on the gold coming down from here. Maybe 25,000, 25,500 because of the dollar strength. If the QE3 gets out of the picture, I recommend gold ETFs directly rather than the gold funds because of the additional cost which incurs if you go in and do for the gold funds.
Alright, so if you have a gold ETF going, it is one of the most efficient ways to invest in gold, and like Naveen was telling us, using an SIP, especially at a time like this, will be most beneficial to you. Well, Saryana Krishnan invests in the Goldman Sachs Gold ETF, Naveen. He wants to know if he should diversify across other ETFs, or is one ETF enough? He also wants to know if one unit of a gold ETF equals to 1 gram of gold. Why is there a different price across different mutual funds? Naveen, first of all, let's answer his first question. Is one gold ETF enough, or should he use several? Because they seem to be rather identical in their functioning.
Sir, you're absolutely right. So there's nothing to be diversified within the gold ETF. everybody performs to the same way. Little bit of the minor differences in returns may come up, and that is predominantly due to the various costs which these mutual fund agencies and the asset management companies who have these gold ETFs being traded on the markets. I think it's just because of that you see a difference in returns. Otherwise, there is nothing at all as such in the difference in terms of the returns. So the returns are same. Why not to go in only for one? And since Goldman Sachs Gold Bs is the largest one in terms of the liquidity also in the markets, I think the one in Goldman Bs staying invested is more than sufficient, and then rather than doing anything else, because gold itself is a diversifier, and Goldman Sachs Bs, if you are continuing to be invested in, you don't need anything else.
Well, we have another question from Leo Leslie, who's written in. He wants to know which is the best way to save money to buy 50 grams of gold in the next 16 months. Should he be using a recurring deposit or a gold ETF or the e-gold contract? I mean, for someone who plans to buy gold over the next 16 months, how should he be saving that money?
See, there are two best of the options. Anyway, the gold returns, if that is not the criteria, I think if you anyway intend to buy gold, there are two options available with you. The one is the gold ETF, which actually is deliverable in 1 kgs and beyond, except for one fund which also gives a delivery on the ETF at 8 grams. So I think the best option therefore would be to either continue doing the investment in gold ETF, and when after 15 months the time comes in to buy physical gold, what you may do is to sell the gold ETFs on the exchange, and whatever money you get, you spend this particular money in buying physical gold. At the same time, you also have one of the things on the National Stock Exchange, the NSCL, the National Spot Exchange of India, where you can buy e-gold contracts, and these e-gold contracts are related to 1 gram and multiples of 1 gram. Now, if you accumulate 1 gram kind of contracts in a period you desire, and you add up to 8 grams to 10 grams of the gold, you may take the delivery straight from the NSCL.
All right, Naveen. So this is what we've learned on this segment, that gold prices have come down, but in the long term, over 3 to 4 years, they might go back up again. Especially for people like you and me who are putting money aside maybe to buy jewelry in 10 or 20 years, this is a good time to go out and pick up some gold. But remember, use an SIP or stagger your investment over the next few months. And you have to remember, if you are investing in gold for the long term, that using a gold ETF or an e-gold contract on the spot exchange is the most efficient way to do so. All right, Naveen, thank you so much for joining us on Investor's Guide and answering all of our questions. If you have questions for Naveen about gold, send them to us on the email ID at the bottom of your screen. Thanks for watching.